Usually when we talk about like a 20% drop in a financial asset, there is this universal expectation
Yeah.
of just pure, unadulterated panic.
Oh, absolutely.
I mean, you wake up, you check your portfolio, and you see that jagged red line pointing straight down, and your stomach just drops.
Right. It's a completely visceral reaction because, we are biologically wired to fear that kind of sudden, chaotic free fall. We see financial danger, and the adrenaline just tells us to run, sell, stop the bleeding.
Stop the bleeding, exactly.
Yeah.
But then you step into the world of high-frequency trading, and suddenly that exact same terrifying red line is, well, it's something entirely different.
It really is.
We are looking at a landscape where that sheer panic isn't a disaster at all.
Uh,
Honestly, it's a highly lucrative engine. So welcome to another custom-tailored deep dive, where
hmm.
today our mission is to completely flip the script on one of the most terrifying words in investing, which is volatility.
Yeah, and it's a huge topic.
It is. Okay, let's unpack this, because today we are analyzing a truly mind-bending 2024 doctoral dissertation.
Right.
It's by Prabhat Kumar from the Swiss School of Business and Management, Geneva, and it's titled Enhancing Profitability in Cryptocurrency Trading, Exploring High-Frequency Trading Strategies Amidst Price Volatility.
The depth of Kumar's research here is really what makes this so compelling because we aren't just looking at, abstract theory.
No, not at all.
He analyzed this massive data set from 2021 to 2023. He pulled historical price and trade execution data across 6 major cryptocurrency exchanges. So places like Binance, Coinbase, Kraken.
Wow, so all the heavy hitters.
Exactly. He looked at the inevitable algorithmic wars that are happening in the milliseconds right behind the scenes.
Yeah.
We're talking about an ecosystem operating on a timescale that humans literally cannot perceive.
Yeah, it's the stuff happening before your screen even finishes refreshing its pixels.
Yeah.
So let's dive straight into the machine advantage. If we look at the actual strategies these high-frequency traders, or HFTs, are running all day, the foundational one, which the study says is used by nearly 40%, actually 38.5% of practitioners, is market making.
Right, market making.
And I've always thought of market making less like some complex Wall Street secret and more like a currency exchange booth at an international airport.
Oh, that's a great way to look at it.
Right, because you aren't taking a directional bet on whether the euro is going up or down. You're just buying it from one traveler for $1.05 and then selling it to the next guy in line for $1.07.
Yeah, that is a perfect mechanical analogy. You are capturing that tiny spread over and over again, thousands of times a minute.
Just skimming pennies.
Exactly. It provides constant liquidity to the market, and it generates a very steady profit for the algorithm. In fact, Kumar's data showed that this specific market-making strategy generated an annualized return on investment of 34.7%.
Which is a staggering return for basically just playing the middleman. But, I mean, I have to push back on the mechanics of this a little bit. If it's really that profitable, the competition must be cutthroat. Like if I'm sitting at home with a gigabit fiber connection, I can't just boot up an algorithm and compete, right? The paper talks about this concept of a latency tax, which kind of suggests this is less about the algorithm's intelligence and more about just, well, raw physics.
Yeah, bringing a gigabit home connection to this arena is like bringing a bicycle to a Formula One race.
A bicycle.
Literally. In
Ah.
high-frequency trading, latency, which is just the physical delay between when a signal is sent and when the trade is executed by the exchange, is really the only metric that matters.
Wow.
The gap between the pros and the amateurs is a massive technological moat. The text reveals a 157-fold speed difference between your standard API connections and what they call co-located servers.
Co-located, meaning the trading firm literally rents physical rack space
Wah.
inside the exact same data center as the exchange's matching engine, right?
Exactly. They are literally cutting down the length of the fiber optic cable so the light has less distance to travel.
That is insane. So you are fighting for fractions of a millimeter of glass.
You are. A co-located server can execute a trade in 0.3 milliseconds, but a standard connection takes about 47 milliseconds.
I mean, that sounds microscopic, but in that 46.7 millisecond gap, I'm guessing a co-located algorithm can see a retail order coming in, buy the asset, and then sell it back to that exact same retail order at a slightly higher price.
Exactly. And Kumar quantifies exactly why that time travel matters.
Okay.
Reducing execution time by just 10 milliseconds translates to a 3.2% to 5.7% jump in annualized ROI.
Just from 10 milliseconds.
Yeah. And that speed advantage is why the single most profitable strategy in the entire study, which generated a massive 47.3% annualized ROI, was latency arbitrage. They're simply racing to exploit prices that haven't even updated yet across different exchanges.
Okay, so speed gets you in the door.
Yeah.
You pay the millions for the co-location, the specialized hardware, all the infrastructure. But a fast machine is only as good as the environment it operates in, right?
Right.
So what happens when the entire crypto market just catches on fire? Because a fast engine is great on a clear track, but I'd imagine a historic system-wide crash would derail even the fastest algorithm.
Well, what's fascinating here is that they don't just survive the crashes, they absolutely thrive in them.
Really?
Yeah. This brings us to the volatility paradox. The data revealed something completely counterintuitive. All 5 of the major HFT strategies analyzed actually performed best during high volatility regimes.
Wait, meaning they make more money when the market is plummeting than when it's just steadily climbing?
Yes. There's one proprietary firm in this dataset case study A that completely upends how we view the May 2022 Terra and Lune crash.
Oh man, that was a bloodbath.
It was. While billions of dollars were being wiped out and Bitcoin was falling something like 55% in 5 weeks, this specific firm recorded its highest ever monthly ROI of 31.7%.
In a single month of market devastation.
Yes. And the reason comes down to what Kumar describes as a volatility mindset. As a retail investor, you look at a crash and you just see chaos.
Yeah, pure panic.
Right. But HFT systems look at a crash through the lens of sophisticated mathematical frameworks, specifically JRCH models.
Right, JRCH. Generalized autoregressive conditional heteroscedasticity.
Good luck saying that 5 times fast.
I know, it's a total mouthful. But my understanding of JRCH is that it essentially looks at the echoes of price swings. Like if Bitcoin drops 10% today, the model isn't guessing if it will go up or down tomorrow. It's calculating the mathematical probability of the aftershocks.
Right.
It's clustering the volatility so the algorithm can just position itself where the subsequent waves will hit.
Yeah, that is a brilliant way to conceptualize it, because the model recognizes that large price movements are typically followed by more large price movements. The algorithm doesn't care about the direction of the asset.
It just cares that it's moving.
Exactly. It cares about the amplitude of the wave. Because extreme price movements mean wider bid-ask spreads, rampant panic selling, and massive temporary inefficiencies across all the different exchanges. It is just an absolute feast for a machine designed to capture discrepancies.
But there is a fatal flaw here, and the text highlights it perfectly, I think, because the algorithms are icy and calculating, and they process these JRCH models without breaking a sweat. But the human beings who write the code and monitor the screens, well, they absolutely do panic.
Oh, the human element is always the wild card.
Yeah. The paper discusses panic overrides, which I found to be one of the most relatable parts of this whole dissertation.
It really is.
It's like you were in a self-driving car that hits a patch of black ice. The car's computer senses the skid, and it starts pumping the brakes and adjusting the steering perfectly, like millimeter by millimeter, faster than humanly possible to correct the slide.
Right, yeah.
But you, the human in the driver's seat, you get terrified. So you grab the steering wheel, yank it as hard as you can, and you turn a mathematically solvable correction into just a catastrophic wreck.
Yeah.
That is exactly what human managers were doing during these crypto crashes.
They watch the market melting down, their biology takes over, and they literally flip a switch to kill the algorithm.
Wow.
And the data shows that by intervening, they actually locked in the losses and made the situation worse.
Unbelievable.
Yeah. The firms that excelled during the crashes had strict model governance, meaning they implemented hard-coded rules that prevented humans from easily intervening during stress events. They basically forced themselves to trust the math over their own adrenaline.
Okay, here's where it gets really interesting, though. Because everything we've talked about so far is spot trading, just buying and selling the actual underlying cryptocurrency.
Right.
But the research shifts gears into what happens when you introduce derivatives, specifically futures and options. For most people, adding futures and options to an already incredibly volatile asset class means pumping a chaotic system full of leverage, which usually just results in blown-up accounts.
Well, it's a completely fair assumption, especially given how derivatives are often used as speculative gambling tools in the retail space.
Right.
But Kumar's paper introduces the modern portfolio theory dividend, and it proves empirically that when HFT firms use these complex tools, they actually reduce their risk profile.
Wait, they reduce risk by adding leverage. I mean, that requires a mechanical explanation.
I know, it sounds backwards, but it comes down to hedging. When these firms combine spot trading with futures and options, their daily value at risk, which is the statistical threshold for their worst-case daily loss, it dropped from 2.89% down to 1.87%.
So they were nearly cutting their downside exposure in half.
Exactly. And at the same time, a fully integrated strategy delivered an annualized ROI of 61.2%.
And their Colmar ratio, which divides their average annualized return by their maximum drawdown risk, was 5 times better than spot trading alone.
Yep.
So they are flattening out their potential losses while basically supercharging their returns.
How are they actually doing this? Because the text outlines a strategy called funding rate arbitrage, and it relies entirely on how perpetual futures contracts work in crypto. Yeah, perpetual futures are really unique to crypto because, unlike traditional commodities futures, they never expire. So, to keep the price of the perpetual contract tethered to the actual spot price of Bitcoin or Ethereum, there has to be a financial penalty paid between the buyers and the sellers.
Right.
And that penalty is the funding rate.
Okay, so if everyone is incredibly greedy and going long on Bitcoin, the derivative price gets way too high. So the longs have to pay a continuous fee to the shorts to keep the system balanced.
Exactly.
So these HFT firms, they aren't taking a bet on Bitcoin's price. They are just buying the underlying asset, simultaneously shorting the perpetual contract to become entirely delta neutral, and then just sitting there farming that funding rate penalty.
You nailed it. And the study showed this captured an 11.7% annualized yield with near zero directional risk.
Wow.
They are acting as the shock absorbers for the market's greed, and they get paid handsomely for it. And another fascinating mechanism detailed in the research is gamma scalping.
All right, gamma scalping.
Yeah.
I always pictured gamma scalping like adjusting your hurricane insurance policy minute by minute as a storm approaches the coast.
That's an interesting way to put it.
Yeah, you buy the options contract, which gives you convexity, and as the underlying crypto price swings wildly, you are continuously buying and selling the underlying asset to keep your position perfectly hedged. So you're just capturing the spread created by the volatility itself.
Yes, that dynamic hedging is the core of the mechanics. But the deeper insight here is why this is so consistently profitable. Kumar's data proves that these HFT firms are fundamentally extracting a behavioral risk premium.
Meaning the math works because human traders are fundamentally irrational.
Exactly. Average traders systematically overpay for options out of sheer fear during market crashes, or extreme FOMO during huge rallies. The research showed that implied volatility, which is the fear mathematically priced into the options premium, was almost always higher than the actual realized volatility of the asset. So the HFT firms are happily selling that overpriced fear to retail traders. They dynamically hedge their own risk, and they just pocket the difference between the human panic and the mathematical reality.
Man. So what does this all mean for the listener? I mean, if someone listening is just trying to participate in this market, holding some Ethereum or Bitcoin, there's an immediate sense that the game is just structurally rigged.
It can definitely feel that way.
Right.
Yeah.
If we look at the latency warfare, the co-located servers, the behavioral extraction, are retail investors just plankton for these algorithmic whales?
Well, if we connect this to the bigger picture, the ecosystem is highly nuanced.
Huh.
It is unequivocally a two-tiered system, but rigged implies a conspiracy, whereas this is just a brutal technological gradient.
Yeah.
The paper actually concludes that these high-frequency firms are acting as a necessary stabilizing force. They provide the continuous liquidity that allows a retail investor to execute a trade instantly, 2047, without price slippage.
Because without the HFTs acting as the counterparty, a retail market order during a crash might drop the price like 5% just trying to find a buyer on the other side.
Exactly. But of course, that liquidity is not free. The HFTs are essentially charging the rest of the market an insurance premium for providing it. And because the cost of entry to that top tier requires multi-million-dollar infrastructure and teams of quantitative PhDs, it creates a massive disparity.
Which is perfectly illustrated by how these firms exploit the architectural differences between decentralized exchanges, or DXs, and centralized ones like Binance.
Oh, the cross-exchange arbitrage.
Yeah, because decentralized exchanges run directly on blockchains like Ethereum, and because the Ethereum blockchain inherently forces everyone to wait roughly 12 seconds for a block of transactions to settle, it creates this massive vulnerability.
Yeah, 12 seconds in this environment is an absolute eternity. It creates what is essentially a dark forest.
Right, the HFT algorithms can see a massive retail trade sitting in the public mempool, just waiting for that 12-second block to process. The algorithm calculates exactly how much that incoming trade is going to move the price on the decentralized exchange. Then, in the span of a single millisecond, the algorithm fires off a trade on a centralized exchange to front-run the movement.
Yeah.
They're literally looking into the 12-second future of the blockchain and executing in the millisecond present of the centralized exchange.
It's wild, and the research shows one firm case study, C, achieving a 54.1% ROI, utilizing exactly those cross-exchange latency strategies.
Insane.
But the arbitrage isn't just technological, it's jurisdictional too.
What do you mean?
While the dissertation dedicates significant analysis to regulatory arbitrage, because these algorithms are just code running on servers, the capital is entirely fluid. So if one nation imposes strict leverage caps or, cracks down on crypto derivatives, these firms don't shut down.
They just move.
Exactly. They instantly route their algorithmic flow through servers in friendlier offshore jurisdictions. They turn global legal uncertainty into just yet another variable to be optimized for profit.
It is a totally different paradigm.
Yeah.
They are surfing the chaos, finding the mathematical seams in the architecture, and extracting yield while everyone else is just trying not to drown.
Yeah, that is the reality of the market microstructure. It's cold, it's efficient, and it is entirely indifferent to human emotion.
So to wrap up this deep dive,
Okay.
the next time you look at a crypto chart and it looks like pure, unpredictable chaos, remember what we unpacked today. Beneath those terrifying red and green waves, there is a highly orchestrated, math-driven ecosystem.
Right.
These high-frequency algorithms, they don't fear the drop. They feed on it. They are turning retail panic, the latency of a standard internet connection, and the very nature of decentralized blockchain technology into calculated profit.
This raises an important question, though, and it's a thought I'd really like to leave everyone with.
Okay, let's hear it.
Kumar's dissertation proves beyond a shadow of a doubt that these highly profitable HFT strategies feast on market inefficiencies, high latency, and those extreme price swings driven by human emotion. But as traditional institutional money continues to pour into crypto, as global regulations eventually standardize, and as technology equalizes the playing field, what happens to the crypto market when it finally matures? If that extreme volatility ultimately disappears, do these algorithmic ecosystems starve to death? And if the primary providers of liquidity suddenly lose their edge, will the fundamental nature of how cryptocurrency is priced be changed forever?
Will the machines starve when the humans finally stop panicking?
Wow.
I mean, it completely changes how you view a market crash. Think about that the next time you see a 20% swing on your screen. Thank you for joining us on this custom-tailored deep dive. Keep asking questions, keep trusting the math over the emotion, and always look beneath the surface of the headlines.